for joining. I'm excited about this one. I have David Buzzard with me. David, hello.
Hello, everyone.
So for those that don't know, David is one of the co-founders of a platform called Deallocker. So Deallocker does a very similar thing to Brickflow, but allows intermediaries and their borrowers to search for equity and mezzanine finance. So we've just embarked on a collaboration between the two platforms. So the integration will go live very shortly. I've been busy amongst some of my colleagues this week, sort of doing the final testing, but we're pretty much there now. So if it doesn't go live this week, then it will be early next week. But essentially what it will allow you to do is source senior debt on Brickflow. And then once you've got your senior debt, you'll then be able to click a button and go through to Deallocker, and it will create an advert on Deallocker that will effectively advertise that opportunity to the investors that sit on Deallocker. David, do you just want to give us a quick overview of the investor mix you have on the platform?
Yeah, thanks, Ian. Look, we're an real estate investment marketplace. We serve both sides, of the marketplace. So we have brokers essentially uploading listings onto our platform, and then on the other side of the marketplace, we have essentially investors. We don't deal with retail investors. We only deal with family offices, ultra high net worths, professional investors. Our minimum ticket size, a club deal, which we'll talk about in a bit, is about 250,000. But if it's a single tranche, it would be 100 grand kind of plus deals that we're talking about here. The types of investors, as I say, are kind of more about the ultra high net worths and family offices. But recently we've started to see actual lenders coming on the platform. So kind of your traditional mezz lenders are also starting to come on, and also some equity guys that are well known in the marketplace. So we're not just talking about individuals here. We are talking about businesses now that are starting to kind of see the benefit of a marketplace.
And give us a number, David, like roughly how many investors are we talking?
Yeah, we're up to about kind of 75, 80 now. But it's
so good coverage, basically, good investor coverage.
Yeah, exactly. And we've not been secretive, but we've not been kind of advertising the amount of investors we've got on the platform because we wanted it to grow organically. We didn't want to kind of boast about it. We didn't want to we wanted to manage expectations as well. Obviously, the first thing that people think about when they think about an online platform is that you're going to get an instant, you put it on and instantly you get bids, and it obviously, as real estate's a complex entity and sector, and there's obviously always various nuances but all we can do is on Deallocker, all we're trying to do is give the developers, the brokers, the best opportunity they possibly can to get their deals in front of investors, and we do that in a way where we use kind of AI and other, it's obviously kind of hot topic at the minute, but we do use AI to kind of structure the data in a way that really kind of jumps out at the investor. So it kind of really kind of focuses on what do they want to see. These guys and girls obviously receive a ridiculous amount of deals in their inbox every day, and so what we're trying to do is make your deals kind of to the top of the pile, really. And so yes, of course you can still email investors and families with your deals, but for us we used AI to calculate, to structure the data in a way that we can calculate the returns better, kind of publish the deals to them in a way which they see the IRR and the return on investments instantly, so they're not having to, okay, I'm going to go into the email, I'm going to calculate what the returns look like for me. And there's also, I've been involved in private equity for kind of 10 years. And, obviously constantly people, whenever you have money, people are always constantly chasing you, asking you, will you do this deal? And for those guys as well, it's kind of very much a, 99% of their time is just say no. And so you're trying to make it, again, put everyone's best foot forward and kind of showcase your deals in the best possible light. Yeah.
I think it's a very similar thing to what we're trying to do with Brickflow, right? You're creating or you're giving the right information to, because for me, senior lenders are investors as well, right? There's no difference.
Yeah.
So it's about putting your best foot forward and showing like the benefits of the deal, also being quite open with weaknesses as well, and allowing that lender to make a good decision quickly, and one that you can rely on as an intermediary to go back to your client and say, look, I'm confident that this is going to happen, because as we all know, the worst part is getting a yes and then it turning into a no, and that genuinely or generally happens when there's not enough information disclosed.
Enough information, enough data. No, absolutely. And look, Apollo's. I saw a video of the Apollo's CEO saying the other day that there's only two ways that you can borrow money: through the banking system or investment marketplace. There's only two ways. There isn't a third. So I think between us, we've covered it.
We're trying to do both.
We're trying to do our best.
Well, we've got both. Yeah. Okay. Great. Well, let's start with why there is a bit of a slides going all over the place. Why there is a bit of a shortage at the moment. So there is, I refer to it as a liquidity crunch at the moment. So throughout the recent times, credit has been abundantly available. Yes, it becomes more challenging in times when the market is less certain. People want decent, high caliber credit, but you can't say that there's been a lack of credit. 2008, 2009, that was a lack of credit. There's been plenty of credit. That what's happened is that the difference between what someone will lend and the purchase price, excuse me, has widened, right? And the main reason for that is because of the higher interest rates. So as we've put here on the slide, for every 1% increase in base rate, that per million, that's 50,000 extra per year, or 50,000, sorry, of money that a developer doesn't get on day one, or a borrower doesn't get on day one. So when you've got rolled interest, obviously that has a significant impact. So you get a gross loan, the interest is taken out. So if that interest piece grows, then actually it's less in the borrower's pocket on day one. And obviously with a huge increase in the base rate in the last 2.5, 3 years, albeit we're starting to see it come down, you've got this massive gap that most developers, borrowers are having to find. And that's at the same time that there's a lot of other issues going on in the market, right? So we all know the cost of living. I'm sure we're all experiencing that firsthand. The borrowers, developers are not immune to that either. And there's also been a slower sales cycle, right? So, they've not been able to recycle their equity as quickly. So you've got almost like a perfect storm. You've got cost of living, you've got lenders needing more money now because of what's happened with interest rates to get deals started. And you've also got less equity coming into your pocket because your existing sites are not selling as quickly as you would like. So across an industry of say 60 billion, we're talking bridging, commercial and development finance, then you're looking at a gap of about 3 billion that borrowers now have to find to do the same amount of deals that they would have done 3 years ago, which is huge. Yeah. David, anything to add?
Yeah, no, I think we came to a similar number. It was I think we looked at national statistics data, 125,000 transactions per year, non-residential transactions. I think there was equates about 50 billion. If you assume that 50% of them will be funded by senior, it takes you 25 billion, and then we assume that 10% of that is, and it is a kind of, it is an estimate, but it's 10% of that is the SME market. That's kind of where we sit really, is the kind of sub-institution market, which I think is what we're alluding to here. It's the, that's where really is, there is the majority of house builders, the local house builders that are actually going to be able to fill that gap or that need in housing right now are the smaller developers, and they're not getting enough enough equity. Then there's not enough equity in the market. Lenders are capping out at 65%. There's a 35% on each deal they've got to find, whether that's their own equity, mezz, second charges, or equity. So as a capital stack, there really is a genuine per year £3 to £5 billion worth of shortfall. And
Yeah.
institutions aren't interested in this space.
Yeah.
There's concentrating. I saw various pieces online about obviously institutions backing these big house builders, but it's nothing seems to be trickling down to the smaller SME market. And and that's where we come in. We want to fill that void, basically.
Yeah, agree. And I think this hopefully is the turning point, as you said on this slide, where things will start to get a bit easier. But that equity problem is definitely not disappearing anytime soon. And even in a low rate environment, people still like to maximize their return on investment. I think that's a key thing to think about as well, is that for a lot of these developers, it's about spreading risk as well, which we'll come on to in a bit. So this is what we're talking about here, really, isn't it? So do you want to talk us through this one, David?
Yeah, I mean, just going back to the other slide, actually. But just going back to the other slide, sorry. What's happened in private credit is private credit's essentially from 2008. They kind of stepped into where the kind of the banking system was starting to step back. They were starting to de-risk. They didn't really have as much appetite for real estate anymore, and essentially that's where private credit started to come in. And private credit, these kind of hedge funds, asset managers that historically had taken on big risks in other sectors and other marketplaces, started to see the opportunity here where they could be making 10-11% on deals which are secured and backed up and with an LTV of 65%. So you can see why they saw the appetite and see the opportunity as the banking system stepped away. So the private credits just come in and fill that void, and it's become such a huge industry for them. And so on Blackstone's they did a market kind of chat the other day, and I really like the kind of the phrase that they've kind of penned in, which is kind of farm to table. So all of a sudden you've got this opportunity. So the private credits never had the opportunity before to get to the table with those borrowers, whereas now they're able to kind of originate deals and bring them to borrowers which they historically wouldn't have had the opportunity to sit in front of. And that's, for me, is where we've got an opportunity as well, is that this farm to table, where we can essentially, between Brickflow and Deallocker, we can essentially, originate those deals, pull all the data together, package them up in a great way, and then put them to the investors. That also, look, at the end of the day, they haven't got the deal flow; they need deal flow as well. They're looking for opportunities. So I think we've got that. We have got the opportunity.
Everyone's got a deployment problem.
Yeah, we all do.
No, absolutely. So this is something we talked about when we were preparing the slides around approaching real estate and like you would any other investment, right? And by spreading your equity thinner, your ability to reduce your risk actually increases.
Yeah, no, exactly. Investors, not all investors, but majority of investors take a portfolio approach on investment. When it comes to the second charge and equity, obviously there is a risk there, and from a risk adjusted return basis, you need to look at it and be manage expectations and know that deals are going to fall over in that space. And obviously, if you plan for, let's say, 1 in 20, 1 in 15 deals that will fall over, then it's fine, because the other ones have made enough to cover the default. And that's kind of I feel that might be a good opportunity for the developers. And obviously, when we speak to developers, that's it's what we kind of, all the brokers we speak to them about, is that, look, why are you kind of putting all your eggs in one basket and essentially injecting all equity into one deal? That deal could also fall over. You're better to use. Obviously, you still need to put some equity in a deal. We kind of, ideally 5% of the total development cost or more, but spread the risk. All right, you're going to reduce your returns by kind of giving away some of your profit, some of your share in the deal. But you could then utilize the other equity that you were going to put in that deal. You could spread your risk and put it into other deals, and or some kind of speculative plays, some planning plays. And you might actually see your returns increase, even though you're giving away profit on one deal. made it returns easily by investing in an option or again a spec deal that will come to market. It's also great to build a pipeline. No developer wants to be in a situation where they're just buying oven ready sites. You're just going to pay a premium. It's okay sometimes, but majority of the time you really want to just build a pipeline of deal flow, right?
And this is what we're sort of talking about here, isn't it? Is this developer life cycle? We just come back to your point there. If I go and see an IFA and I've got, I don't know, £1 million to invest, and if the IFA tells me that I should invest £1 million all in one company, I probably walk out the room.
Yeah, exactly.
I just think the guy is not very sensible and is ignoring any kind of history on terms of diversifying risk. But as you've just identified, a lot of developers will have £1 million and put it all into one deal, which, there's macro events that we can't control. There's even, localized events that could happen with that particular market that we can't control. So, you're absolutely right. And this is what this sort of diagram alludes to as well, is that, for developers, especially now with this elongated planning process that everyone just seems to be having problems with, when I used to think about a developer in the space of coming to market with a site, the delivery of that site was often 2 years, and that included planning, right? Because planning was always, no more than 3 months for SMEs. It could be a bit longer for much bigger schemes, but almost entire, you would 2.5 years. And if you think about a developer, their career 25 years, let's say, then 2.5 years per scheme, that's 10 schemes if they're running one after the other. Whereas now we're often hearing of people that are seeing that cycle elongate to 4 or 5 years. Okay, so if you're in that situation, all of a sudden your 10 deals in 25 years shrinks to 5 deals in 25 years. You've got to make the same amount of money from half the amount of deals. So spreading your equity, and actually, and this is something we talk about here, is that deals with no planning and outline planning, they're a lot harder to get funding for. But I know that you will fund those on the platform, David. We'll come back to in a second. But the point being is, use your equity where there is bigger investment returns, uplifting value to push these sites forward. And once you get to the full planning out of the ground stage, that's actually where it becomes a lot easier to attract investors, through your platform and wider, right? Because you've de-risked it. You've actually taken out the majority of the risk of people, which is the uncertainty of planning.
Yeah, no, exactly. Look, as you alluded to, we do fund kind of pre-planning deals as well, but you're right, that they are a bit harder, and there's not as many investors that will take on that sort of planning risk. So you're absolutely right that you're better to try and get it to a certain point, or even get it to a point where you've got a pre-app, and then you bring it to the table. Anything that can de-risk it a little bit to you've got a better negotiation position when you're coming to the table with an investor as well. The other point I'd really kind of really keen to make as well is that the LTV, obviously, lenders, including MES, can get up to kind of 75-80%. But any more than that, you are starting to really push the boundaries and push what's possible for that deal. And if there's delay, obviously you've got first charge lender interest, second charge interest. There is, you're getting to the point where you're really starting to risk, going into default and the site being seized. And so from a kind of developer's perspective, it's you're probably better just to keep on the side of 65% on the LTV for the senior, up to 75% on the MES, and then anything above that, you really just want to be in the equity space. You don't want to push. You do not want to go too high on the kind of LTV, LTC side, especially on the LTC side, obviously, because you really don't want to be on the if there's a delay and having to stare at interest costs spiraling. Whereas equity, obviously, you don't pay interest. There are situations. Some investors may ask for a coupon sometimes, but majority of them don't ask for interest coupon on the investment. So if you you know, if you take on equity rather than you know, debt, you obviously you're better off in those sort of situations.
Well, I think it is probably a situation where you maximize your senior, but you're right, like that mezz piece is perhaps the part that, you know, in the recent past might not have served you as well, because whilst it appears on paper to be cheaper than the equity, you're absolutely right. You know, equity generally, you know, you're aligned in terms of the profit and the risk, but
Yeah,
you know, the mezz piece, if you've got an elongated sales cycle, which most people have seen recently,
yeah,
that mezz at 20-25% is racking up pretty quickly, right? On top of the senior. So yeah, if you're looking at getting the maximum senior you can, obviously at a sensible rate,
yes,
then that next piece of the stack, that equity or mezz piece, you know, there's an argument actually, you know, now and potentially, you know, going forward, with rates at the level they are, that actually equity is possibly the more sensible play than a mezz slice.
I think there's for every deal is different, and I think there's an opportunity on both sides. I think it's just knowing you know, where the boundaries are. And yes, anything's possible. You can push a deal as far as you can. Everything's fine until it goes wrong. You know, majority of deals go, you know, go over program, as you say. So, you know, it's just kind of making sure you've got enough contingency in there. We'll obviously touch on these points probably later in the presentation, but
yeah, so you just go back to this diagram quickly. I mean, the way that we always think about it is, you know, a developer to have, if they can have 4 pipeline schemes, so they've got one coming out the ground, they've got one that they're just completing on, and then they've got two or three perhaps that they've got coming through the pipeline, through the planning process. Obviously, equity is needed here because you need to pay planning fees, architects, you know, all of that kind of stuff to get them through. So, you know, that time between when you sell a site and when your next one comes out the ground is dead time. Yeah. So if you can, you know, put your equity across multiple sites, you reduce that dead time.
yeah.
And if we talk about that 25-year timeline development career, you know, the more you can minimize that dead time, it's a bit like an aeroplane, isn't it? You know, with the EasyJet, Ryanair kind of mantra, the whole time the plane is on the ground, it's not earning money. It's very similar here. You know, the whole time you're not on site, you're not actually earning cash. So
yeah, cost of capital,
that's the approach we talk about.
Mm.
Here's a case study that you wanted to highlight, David. So do you want to run through this?
Yeah, it's probably this slide and the next slide that kind of touch on each other. But essentially, it's you know, I guess we wanted to make sure that everyone was aware that with Deallocker, you know, it's not a case of any sort of second charge mezz equity deal. We have investors there. We've kind of used this as a case study, recent deal that we closed on the platform. And this is kind of a textbook deal, really. You know, seasoned developer in kind of, you know, busy borough of London, nice borough near schools. You know, they wanted second charge, but they're willing to put up 100% PG. They had a corporate guarantee, which was made up of, you know, they had various assets and cash in the business. 18-month deal, which is, again, it's this kind of nice. Investors don't really like anything over 2 years. They're not really interested. Doesn't really appeal to them as much. On the LTV, LTC side, LTV, you know, this one was at kind of 70-odd%, which is ideal. And the borrower's putting in 10%, you know, equity. So I think this one was a really nice deal. £500,000 ask as well. You know, you can ask. You know, on Deallocker we've had people ask for 10 million of equity in mezz and down to 100,000 of mezz. You know, half a million to $1 million seems like a real sweet spot at the moment on the site. And so obviously I'd definitely recommend that. And whether or not you split it up, you know, you could split it up of equity and $500,000, then a mezz $500,000, maybe it's two entities, and that is possible on Deallocker. You could go out on the same deal, but go out, you know, for 2 different entities to invest, one on the second or one on the mezz and one on the equity. But yeah, look, this is a really nice deal. I think one thing, you know, this was a family office, and they can move quickly. You know, you've still got the due diligence period, but it is a case of, you know, once that due diligence period over, it is a case of a 5-day to kind of cash call to draw down the funds. quite a few of our families are based abroad, and that's a big thing that we're pushing at the moment. And I'll come on to that a bit later, but it's, you know, the cash call, you do need to allow 5 days for it. What was really cool in this one as well was that the investor was happy to be able to move the deal quicker. They were happy to take reliance on the report on title to the legals from the borrower, the report, the valuation, and the PMS report. So they weren't requesting separate reports. So it reduced the time and also reduced the cost. So
yeah, that's good. I mean, it's a good point actually in terms of the amount. The way that we need to think about this as intermediaries is that ultimately, you know, the due diligence on a deal is the same whether it's 100 grand or 1 million.
Yeah.
But obviously the return is a tenth at 100 grand than it is at 1 million. So you know, be mindful of that. It's the same as if you go to a bridging lender at 100 grand, they're much more interested in the loan at 1 million, right? So you know, bear that in mind if you put in sort of smaller deals, less quality, you know, lower caliber deals, lower caliber sponsors, you are going to get less interest. So just please bear that in mind.
Yeah, I mean, look, we do have families in the platform that actually do minimum. You know, we a couple of families that minimum 5 million ticket size. You know, so there are investors there, but it's just the majority are the further kind of small deals, and that comes back to that kind of portfolio mentality where they'd like to just do £500,000 in 20 deals or 30 deals a year, you know, rather than doing all in one. So it's the same sort of thing.
Which kind of brings us on to this, right? So the idea of a club investment deal.
Yeah, so I mean, it's quite common within family offices to kind of share the risk, share the experience, share the due diligence, and you know, we've seen it quite common now on Deallocker where families are coming together, sharing their deal flow, and investing alongside each other. It's called a club deal. You know, really keen to make sure that everyone's fully aware that it isn't any sort of like peer-to-peer lending or crowdfunding or anything like that. It's literally a case of kind of family offices coming together, 3 or 4 families coming together, and again, kind of sharing due diligence, sharing experiences. You just get more comfort. You know, for a family, you get more comfort if another family is coming in. You know, they're putting their own money where your mouth is, I guess. So that's
similar in the senior debt space to a syndicated deal, isn't it? You know, you have a lead underwrite. You know, perhaps if it's a larger loan, lender typically caps out at 30-40 million. It's the 60 million ticket. You know, they like the deal, but you know, they want to share some of that risk with another party or other parties. So they could be lead underwrite and, like you say, share the due diligence. So you might have a Shawbrook that does the lead underwrite, and then you get 2 other banks that kind of sit alongside them. So yeah, just exactly the same principle.
Yeah, and it's certainly nothing to be kind of scared of or like any sort of kind of wary of any, you know, obviously if the way it works in Deallocker, you know, everything's confidential until you've signed an in-app NDA. You have control whether you approve it, and then we allow kind of indicative offers in-app, and that's essentially to really kind of help the club deal, you know, work, I guess. So and the families can say, well, okay, we'll do 200 grand of that deal, or you know, £500,000 of that deal, but you might get, you know, offer from a family that's willing to take on the whole tranche, and obviously, you know, that is the case. You probably would pick that one, but there's certainly no reason why you wouldn't, you know, do it as a club deal. Club deal is everyone sits on the same document. Everyone sits, whether it's a mezzanine loan, a second charge loan, you sit on the same document. If you don't, there'll be a lead, and they will just have a participation document with the other family. So it's really not a big deal, big issue. Or you might, you know, again, it's just you might share lawyers. All right, you might have to have 3 different calls. So the broker takes it offline, has a initial call with the investors. But look, the way the Brickflow is obviously collated the data. You've got the deal in principle there. When it comes to Deallocker, everything is populated, so all the information's there. You can download all the attachments on the deal. So when the families kind of make an offer, they really, you know, they really are kind of there to do the deal. There might be a couple of queries, but they know the ins and outs of the deal, you know, within reason. And so there shouldn't really be any showstoppers and any kind of issues. You know, I expect the first call to be, and again, answering a couple of little kind of queries, but then it'll be just straight into, right, I'll just put you straight into the borrower's lawyers. So again, there's no issues. And I obviously am more than happy to have a chat with anyone who's kind of wants to know more about that sort of situation.
Take anyone through it. Yeah.
But the other thing probably to, sorry, just going back to the other slide, sorry. When it comes to the SPV formation, there will be KYC and AML, obviously on the stakeholders. So there might be the kind of 3 sets of KYC and AML. One of the big things that a Deallocker is trying to remove pain points, anything that slows progress, anything that is not giving the equity and investors comfort. So kind of the world exclusive here, Ian, but we've actually launching on Monday. We're launching kind of our own SPV and banking solution. So we'll be able to basically within 72 hours, we'll be able to create an SPV to KYC AML, and then it automatically sets up a bank account. We'll set it up with a couple of partners called Trustmore, a big administrator, and a company called Alpha, which works with Citibank. So essentially, you get a Citibank bank account alongside your SPV. So I think we've kind of, as we've gone along this process, we've started to see where the pain points are. We took feedback from where are the issues in the industry, and obviously getting investors at the table, getting lenders at the table, and so we're trying to deal with that. So hopefully that would be really beneficial. And obviously, DM me if you have any queries on that.
Yeah, no, absolutely. Sounds like a very worthwhile service. So now we, just as an educational piece for those that don't know, difference between equity and mezz.
Yeah, I mean, as we kind of alluded to before, kind of, every deal is the same sort of due diligence. It's the same due diligence, whether it's equity or mezz, but obviously there's different factors. Mezz, you get a charge on the deal. So on equity, there's more, a lot more kind of due diligence, and obviously looking at, the real kind of sensitivities around the deal. Again, you're still going to run sensitivity analysis on a mezz deal, but you really kind of want to, hone in on, because you haven't got a charge in the deal. So the deal needs to be, super profitable, great sponsor who has, really good track record. You don't want too much, obviously, you're always going to have debt on the deal, but, you don't want it to be too high on the LTV, LTC, because you don't want the bank seizing the site. Your equity position, you'll just be underwater. So that's really key. And, one of the things, a couple of, my personal experience in investing is, a lack of governance on the kind of SME deals. And what we're trying to do is really kind of get investors as comfortable as possible with SME deals. And again, one of the reasons we've created this SPV series is to have governance. So each SPV has an independent director overlooking the company. So investors get comfortable that the company's been running and the SPV's been running and having governance on that is just, is going to give investors a lot more comfort. So when it does come to equity deals, they know there's governance. So, okay, they haven't got a charge, but the cash flows in and out of the business are all being run, correctly. And obviously no one's saying that they won't, but from an investor, they don't know the borrower. Obviously you see the experience, they see that they've got obviously a dip from a senior lender, but they don't know them. So giving them as much as comfort and confidence as possible that this deal's going to be run in the most professional manner is what we're trying to do, and trying to obviously help the developers and the brokers to get that across. In regards to interest rates, where we are obviously at the moment, probably second jars mezz, probably around kind of 18-20%. It's come down slightly where it crept up last year. I think it's come down a little bit more competition. Still a lot of deals out there, but there is, it has come down slightly. Interest rates, or obviously on equity, don't really apply, but from there is kind of what we call pref rates or promotes, and obviously a profit share. But the pref rates and the promotes, the developer can actually benefit from that. So some of the investors may say, well, look, when the deal's finished, we'll both take a pref rate, so we'll take a little bit out. We'll then both take a promote, and then we'll do a profit share as per the shareholders' agreement. So there is kind of, it's not all take from the investor. It is a case of again, they're sharing the risk together, they're going on the journey together. But obviously we just need to incentivize the developer as much as possible. And that's why it's really key that they have these kind of promotes and pref rates. And, because even if the deal is a bit underwater or it's not been as successful, you still want the developer to obviously, be incentivized to do a good job and do
finish it
as well.
Yeah, and I mean, in terms of governance, step-in rights or seat on the board, what are the typical things people are looking for?
Yeah, I mean, obviously investors, prefer kind of priority return. So that's probably the first thing. So they kind of get paid out kind of from a profit share perspective, they get paid out before the borrower. I guess that's from kind of waterfall payments. So once the payments come, that's how it's structured. Seat on the board is obviously, it's more about control. So it's, they just want it to be run in the best way. They don't really want to be involved in the project. They want the developer borrower to run with the deal. They're backing them because they're experienced and they don't want to be involved. They don't want to step in, and that's a real kind of worst case to have to step in on the deal. So they want to leave them to it. But I think it's that kind of control of being able to, I guess it's almost a warning to the developer that I am here to step in if I do feel risk from going wrong. But it's not something that anyone wants to do. So yes, they will, potentially ask for control, but that's nothing. But again, that's why pushing for this kind of independent governance on an SPV, so the investors don't have to feel or have that burden, or the borrower doesn't have to feel that the investors breathing down the neck, by having that independent governance to make sure that everything's being done properly.
Yeah.
Equity returns probably, I mean, we are kind of, I put on the sheet there 1.7 to 3x. 3x obviously it would be an amazing return. It's more on the kind of plan in place, the value add stuff. But there's a deal went on the other day, 1.5x, and it's a nice deal. There's a social side to it, and I think it's one of the things actually starting to see. If we use AI to run kind of the summaries of the deal, so you input all the data, we structure it, and then you can run AI. But I have started to see recently putting a bit more kind of personal touches also on the summary also helps. So on that deal, for example, they touched on the fact that they've got personal, there's a social side to it, and hopefully that has appealed to quite a few different investors actually on that deal. So
yeah, it's great. Good to see.
Probably just touching on kind of sensitivity analysis and comparables. So again, sensitivity analysis, I'm not sure how many people have used that in the past. I think it's starting to get a bit more common now. But where we're talking about here is obviously you understand what your profit, the worst case profit's going to be, or the best case profit. Sensitivity analysis enables you to calculate, obviously, if costs run over by 10%, if values come down by 10%, is it still going to be profitable? And on a kind of general rule of thumb, it needs to be at least kind of, if costs go up 10% and values come down 10%, you need to be still at least breaking even at that point, ideally making even something. If you don't have that, you really kind of probably wouldn't touch the deal. So that's kind of super important. We do that on Deallocker. We provide that as a tool for brokers and for investors, so they can see what, as soon as they've uploaded the deal, they can see what the sensitivity looks like. And also on the comparables, again, we do an analysis, and again, this is going back to giving the investors the best possible, or putting the deal in the best possible light, and giving them as many tools as they can to quickly see if they're interested in that deal. And one of the things we do is comparables. So we use APIs to pull data from sources, from live sources. We use the postcode. We run analysis and comparable data, and pulls back comparable data on prices per square foot, what's the yields in the area, build costs in the area. So we can quickly check, and the investors can quickly check, and the brokers as well, when they've uploaded a deal, whether this deal kind of does stack up. And it's just super important that also the brokers have a handle on that as well. That they're also peddling deals that actually work and actually stack up. Yeah. It's okay taking the word for it of a developer. I'm sure that they're right, but at the same time, sometimes they are a bit too keen, and maybe take the first comparables they've got, rather than running a market analysis on it. So
I think quite often that sort of has come out through the senior issuance process, but just conscious of the time, David. So I just go on. But
yeah, I think we've touched on quite a lot of this already, actually. But maybe
yeah.
touch on, maybe we haven't really kind of talked about kind of the senior lender side. So choosing the senior lender, I think that's maybe something we should touch on.
Yeah, I think just with this slide here, I think the main points are, sometimes deals that need equity are the sponsor has no money, no experience, they're getting started. That is a very difficult deal to place. Like it's difficult to get senior borrowing for somebody that has no experience and no assets. It's even more difficult for somebody that is asking someone to participate as an equity investor in that deal on that profile. So just you need to bear that in mind. Anyone that's using it is, if you're just putting up Hail Marys on people that really are struggling to get senior terms, is going to be even more of a struggle to get the equity. So that's just something I wanted to say. There are legitimate reasons why experienced developers don't have equity. They have 2 or 3 sites that have either gone long, or the sales cycles we talked about earlier has gone long. I was speaking to you about something the other day, David. A guy got divorced, and therefore he'd lost part of his balance sheet through that process. So there are legitimate reasons. But if you've got a first-time developer, what used to be called ninja during the ninja deals during the credit crunch, no income, no job, no assets, that's not something that's going to get much traction on the platform. So strong deals, good profit margins, decent sponsors that you've been able to get senior terms from through Brickflow, that they definitely are the kind of caliber of deals that are going to do better on Deallocker.
Yeah, definitely. It's not just all about the rate and obviously the amount of money, the LTV you can get out of the deal. You need to obviously also take, like you say, just kind of have a look at the background of the lender. And do a bit of your own homework on that lender, really, and just make sure you're comfortable and get in taking on, working with someone that you haven't, maybe, well, you need to do the research.
Yeah. So just here, I mean, we're not actually doing a demo, just because it's a bit clunky to go from the slides to the platform, whatever. But here's just like basically a snapshot of what it looks like. So this is an exclusive relationship between the 2 platforms. The idea is that Brickflow users secure their senior terms in Brickflow. They then can click a button. So as you can see here on the left-hand side, next to Lend Invest, they've provided a decision in principle. It's met the parameters that we've coded into the platform. And that button there becomes available. So equity and MES is available. You click that button. It will then ask for your permission to transfer details to Deallocker. And then you'll go through into the Deallocker platform, and you'll go through a journey, which is very easy to get through. I've had to run through it quite a few times myself this week while we've been testing. It's all very clearly laid out exactly what you need to do. But a lot of the deal summary information gets sent over, and also the senior term parameters get sent over as well. What doesn't get sent over is any of the client personal information, any identifying information around the deal. It is simply an advert that gets posted on Deallocker that then goes out to the 75 plus investors that are on David's platform. And they get notified, and they can come and then see the opportunity. They then have to sign an NDA to get additional information on the actual deal itself. So there needs to be good buyer interest, and they're happy to sign an NDA before they can go to that next stage, which would be then when, as I understand it, David, they provide indicative terms, and that would be, if they're of interest to your customer, that would be when you engage with them to get it to that next stage. So that's basically the journey. Senior terms in Brickflow. Once you've got your decision in principle in the deal forum, you can then click that button. It automatically creates a listing in Deallocker. Deallocker's guys are notified, and then you'll be notified each time there is an indication of interest or expression of interest within their platform. which you can then share with your customers. So, and not like to, put too fine a point on this. You're talking about something where you're able to get senior terms from almost the whole market within Brickflow within a matter of a deal presentation. Takes about 20 minutes in Brickflow on a development deal. You then click a button, it goes off to the senior lenders. You then get your senior terms back. You're then clicking one more button and you're getting it in front of 75 genuine investors that will look at deals that are used to looking at deals on an equity and mezz basis. That is something that would take weeks and weeks in the real world, that we're basically scaling it down, something that takes minutes. And there will be teething issues here, be patient, but and obviously alert us to any issues, to any improvements or anything you don't think it works exactly. But just please bear in mind that what you're doing there is something that a year ago would have taken you weeks or months to do, and you're able to do it very clearly and show your customer like the audit trail of the senior lenders you've gone to and the investors that you're going to. Yeah. David, anything to add?
No, that was a very good summary. Thank you. You should come work with Deallocker.
I'll put my CV in.
No, that was great. No, exactly. And just just touch on, we don't charge a subscription, because really kind of we want everyone to obviously use the platform. The first deal's free, then we charge £20 to list a deal, and then we charge 75 bits on mezz and 1% on equity if it's successful. So our business model is more about, we want you to get used to the platform, get into the platform. And obviously the more deal flow on the platform, the more investors will come to the platform. So there is a bit of a mutual thing here where like we've done, there's a lot of hard work and investments gone into building, both Brickflow and Deallocker. The more people that use it, the more that traction it also gets on the other side, on the investor side. Because as soon as they start seeing that, okay, this is the place to be for those sort of deals, then the more chance you're going to have, more investors are sat there. So there's a dual kind of thing here.
Yeah, I agreed. You use it or lose it, I guess, is the phrase, isn't it? This is a great tool. The synergy and the ease to migrate from one platform to the other. Once you've created your deal in Brickflow, you're not double keying, you're not rekeying. Everything is quite seamless.
Yeah, I mean, from the investor side, it's it's fantastic being able to know that the data that's being pulled through are the actual numbers, from the deal in principle, and again, it probably goes back to almost that club deal perspective where they get comfort from other people coming in on a deal. It's the same that the lenders are there, the decision in principle's there. So they, it just brings so much more, so many more investors will come to the table, will do the NDAs because they get the comfort there, that the ranks are there. We do actually also, sorry.
I was just going to say, I think that's really is the key thing is that, I've quite often speak to brokers. I've spoken to borrowers in the past as well, going, I've got my senior terms, I just want the equity. Well, the problem is that have you got the best senior terms, right? The other issue you see as well is people go, I need equity before they've got the senior terms. Well, go to an investor and say to them, I want equity. And when they say how much, you go, well, I don't know. I haven't got my senior terms yet. Okay, what's my return on investment? All of this stuff. If you don't know it, then they're not going to be able to work with you. And straight away, that understanding of how like their calculations work, or misunderstanding of how they will price that deal, immediately they lose confidence in you, right? Because,
absolutely spot on. Or the investor might put out terms and then all of a sudden they change it. So actually we need twice as much equity. And then they just get not as much interest anymore. Yeah.
So senior terms, get those, then everyone knows exactly what's required. They can work very quickly on what the return on investment is for the equity piece. And the whole thing's just much cleaner and easier. I think that was it for today. So we try and wrap up. There's a couple of questions, so I'll fire these over. Rory O'Mara, I assume a club deal does not breach any FCA guidelines on collective investments. David?
No, obviously everything's non-regulated deals. The investors, we're obviously a marketing platform that lists deals. We're just essentially bringing you kind of, I guess, very warm leads. All the investors are professional investors, sophisticated investors, their own our own entities. We have no we're essentially not selling the deal to them. We're not advising them to do the deal. We are only listing the deal. It's up to them. They come to you or come to us if they want to do a deal. We're not. We're certainly not, and the brokers are certainly not trying to sell the deal into them. They're doing it on their own accord.
Yeah. Okay. Fine. And effectively, it's down with their lawyers to paper the transaction in a compliant, regulatory compliant way.
Yeah. Exactly.
What are the reasons? So this is from Rochelle. What are the reasons for Deallocker not being a P2P platform per the FCA?
Yeah, I think there's the missing on the market. We feel there's families out there that are ultra net worths that aren't retail investors, the professional investors that there isn't. It's always been very much like an old school kind of. There isn't a platform that they can use. And Deallocker serves that purpose. There's already some great players out there that do retail investment, and we don't want to go into that space. It's not our space.
So Rochelle's got a couple more questions. You might want to pick up with her afterwards, David. Also, who is liable on the equity deals, as someone will be arranging these investment deals which fits under a different bracket than loans per the FCA?
Sorry, repeat that question.
Who is liable on the equity deals, as someone will be arranging these investment deals which fits under a different bracket than loans per the FCA? So essentially, if the advisor, let's say it's a broker that's coming through Brickflow, and they're a mortgage advisor, where does the liability lie in the event of them procuring an equity deal?
Yeah, again, it's down to the investor. It's their own choice. It's their decision. No one's advising them. That's not something that we do. We can provide. We have a local partner service where we can provide to manage the deal out, but it still comes down to the investor to make the decision. No one's advising them to do this deal. No one's recommending to do the deal. Say it's a marketing listing. So from a broker's perspective, again, they list it. They're listing a marketing listing and advertising. It's an advertisement essentially, which then the investor comes to you. So you're not trying to get them to do the deal as such. And that's the key here. You're not advising them. You're not recommending the deal to them. You're putting it out there and they come to you. Yeah,
cool. Another question, who are the investors? Anyone, just family offices or private individuals as well?
Yeah, a mix of both. We every week we're having new investors come on board.
Essentially all sophisticated investors.
Yes, yeah, 100%. Yeah, all sophisticated and all either ultra net worths or there are some high net worths on there, but again, they're all professional and not retail. You're dealing with people that have done it before and are professional.
So Jim Selly, stupid question, no such thing, Jim. Very new to this. What is a promote?
Yeah, so when a deal, essentially, it's almost like the promotion. The promote is like you've both brought the deal to the table. So let's say the borrower's brought a deal, the developer's brought a deal to the table, and so has and obviously investors there. So they're both sitting on the deal. Maybe there might be other shareholders, but maybe you're both sitting there in a position where when the deal's complete, the promote is a case of almost giving yourself like a bonus that you've completed the deal. The pref rate is, I guess, you paying yourself almost a coupon on the deal. that again you've completed it. But the promote is really kind of like yeah, you've completed the deal. It's like a bonus for completing the deal, and then you get a shareholding. Reason for these kind of different, promote and preferate is really around, again, it's the incentivization. If there isn't a huge amount of profit left in the deal, and the developer, let's say, has got a 50% share in the deal, and there's actually not much profit left, you still want to be able to have a promote there for them to kind of get. It's like a bonus that they get when the deal's done, just in case there isn't much.
Bonus.
That's pretty much the best way.
Okay. Can you remind us on Deallocker pricing again, please?
Yeah, £20 to list the deal. First one's free, and then 75 pips on MES and 1% equity only on success.
And presumably the person listing the deal can add an additional fee. Is that how it would normally work?
Yeah, we basically build we call deal provider, so the broker. So we
build the investor.
So it's up to them, obviously, what they've charged the developer, but just they need to build in our kind of 75 pips or 1%.
Yeah. Okay. And Luke, will you be sharing the slides? Yeah, I can share them with you, Luke. No problem. Martin, would you be able to fund conversion and bigger refurbs or only ground up?
Yeah, definitely. I mean, personally, I love conversions. I love existing buildings, and there's a lot of investors that the same mindset. I feel there's less risk in them, and yeah, a lot of investors feel the same way. So yeah, 100%.
So conversions, yes. Refurbs, possibly not, but
refurbs as well. Yeah.
Okay.
Yeah, exactly. As long as I guess it's value add, as long as there's value add there, and but we have some families and there's some second charge lenders that really kind of I suppose we haven't really touched on this as much, but really kind of commercially minded, really flexible on kind of the assets and obviously how funds are distributed between assets, taking charges on certain things and then distributing funds in different assets, and really kind of flexible. So and that's kind of from a high net worth family office standpoint. That's how they kind of view stuff. It's really kind of commercial minded.
Yeah. Okay. Cool. Lee, are the clients charged with additional arrangement fees, etc.? So we've kind of touched on that, but essentially there's a platform fee, and then the person listing needs to effectively charge their client a fee.
Yeah, obviously we don't whatever they charge their fee to the borrower, we obviously don't need to know that, just as long as we get ours. There will obviously, if it's a MES deal, there will be the standard kind of probably 1 in 1 out, that sort of situation, but that's no different to how they're used to it.
Understood. And then Steve, I think I heard you say there's little interest in equity that extends beyond 2 years. I have a client who needs long-term patient capital for a range of projects because they wish to retain the asset. Is this at all possible? Just, quickly on that, Steve, as I understand it, Deallocker is very much a project-by-project equity piece. It sounds like what your customer needs or client needs is almost equity at top co level, which is a very different product. David?
Yeah, no, exactly. Probably look at it from again, I've got some lenders on there that would look at it of kind of holistic basis, and yeah, look at it from a company perspective, and maybe if it's that asset, yeah, you're right, that doesn't suit them, but maybe you've got some other assets in your portfolio that they can look to take equity out of there, or give you a loan on the basis of having a second charge on one of your other assets, and then you can use those funds to service the requirement on that kind of longer asset maybe. So it's just something that, again, the families on there are a bit more kind of minded to that sort of structure.
Steve, by all means, drop me a message on that if you want, because we've actually got one of the investors in Brickflow. He's happy where there's a good developer that has a good pipeline of projects, but needs equity at group co level, top co level. He's happy to look at those deals. So by all means, reach out to me, and happy to take that to him. I think that was it. So thank you, David.
Thanks for having me.
Yeah, for anyone that's coming to Auto Vivende tonight, looking forward to seeing you. And Yeah, thanks for joining.